Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Greg Dickerson. Thanks for being on the show, Greg.
Hey, Whitney, thanks for having me. It's good to be here. Good to talk to you again. Good to see you.
Yeah, you as well. Great to have you back on the show. I encourage a listener to go back and listen to an earlier episode with Greg. Probably, I didn't get the show number down in time, but probably at least a year ago, or we were determining maybe a year and a half ago. I'm not sure now, but
yeah, you're on 468 right now.
488.
488. Yeah.
So. Yeah. But Greg, thank you again. You're definitely an expert in this space, and we're happy to have you on the show. And but a little about Greg, in case you missed the earlier episode, he's bought and developed and sold over $200 million in real estate, built and remodeled hundreds of custom homes, commercial buildings, and started 12 different companies from the ground up. He's an expert on the topic of real estate and construction, and has been a commentator on the Fox Business Network with Neil, how do you say that name?
Yeah, Neil Cavuto.
And Dave Ramsey. Written articles for magazines and newspapers, and is a featured contributor in the book Walking with the Wise Real Estate Investor and Walking with the Wise Entrepreneur, featuring Donald Trump, Susie Orman, Rachel Barnes, and others. Greg, thank you again for your time. Why don't you give us an update of, what you have going on right now? Let's dive into, to your superpower.
Yeah. So, I've got a lot going on. I have projects going on all over the country that I'm working on with people. So I do coaching and mentoring. So I have people all over the country, and, I'll get involved with deals with them and businesses as well. So I do real estate, development, investment, and I do equity capital. So we buy companies, fix them up, sell them, or we roll companies up. So it's a value add company play instead of real estate. So those are the two things I do, and I'm all over the country with those, but I do have clients all over the world. So, I've gone international since the last time we talked with the coaching and mentoring, and but all of my deals are primarily in the United States right now. I have not done deals outside the United States yet.
I'm sure that's in the future. I don't doubt it a bit.
Yeah, it'd be a lot of fun. I'd love to travel and so that's definitely something I'm thinking about, but it's different. You got to be careful, when you start doing stuff outside the country.
So, Greg, with your experience, and especially with doing, deals in a lot of different places, and just as long as you've been doing this, I would love to kind of hear your take on the current market and what, your thoughts are on kind of what's happening and where you see going, over the next year or two.
Yeah, we're definitely at a peak in all asset classes. Now, a lot of people confuse type and class when they're talking about real estate. So asset classes are, real estate is an asset class. You have cash, you have stocks, and you have bonds. Within real estate as an asset class, there are types of real estate. You have commercial and you have residential. In commercial, there's 6 main types. You have office, retail, multifamily, industrial, hospitality, and land. So within those types, you have subclasses and subtypes, and you have classes A, B, C, D. So right now, pretty much all across the board, we are seeing, we're maxed out. We're at a peak all across the board, all asset classes, cash, bonds, equities. Everything is at a peak right now. Real estate, all the different types and all the different classes and all the different types have kind of maxed out because interest rates are so low. This economy, we are strictly interest rate driven. What I see is a bomb about to burst in the equities market like we saw in 2009 with real estate. I think that's where our big issue is right now that you really got to keep an eye on. Interest rates are key for all of us in real estate. That's what's making these deals work. When the cap rates compressed like they have, you're seeing 4s and 5s. You're lucky to find the 6 anymore. Mm-hmm. What's making that work is interest only, 3 3/4 to 4%. So you really got to watch those interest rates, and you really got to be ready and be careful and be nimble, to adjust. The price you pay for an asset's permanent. The debt is temporary. The financing's temporary. So you can restructure, you can reorganize, and you can rearrange the financing, but whatever you pay for that asset, you're stuck with that. You ain't getting out of it. So that goes both ways, right? It can be good on the bottom, it can be bad on the top. So what I tell everybody is the most important thing to know is the top. Everybody says you make your money when you buy. Yeah, that's great. But if you don't get out at the right time, you haven't made any money. So you really need to be careful. You need to make sure that you're really thoroughly understanding the properties that you're looking at and underwriting, breaking the metrics down at the door level, and paying attention to insurance. Insurance costs are up and they're catching a lot of people off guard. Taxes are readjusting when you purchase an asset. That catches people off guard. Utilities. So utilities companies in different areas are pushing for rate increases because they haven't had them in a number of years, and the winters and all the storms that we've had, their costs have gone up. So, and fuel costs, so just as you're underwriting deals, just watch those metrics. But, right now I feel like we are we're at the top. Cap rates are about as low as they've ever been. Interest rates are very low. So it's all relative. When we were buying 7 and 8 caps, interest rates were 5 and 6. Now we're buying 4 and 5 caps, interest rates are 3 and 4. So, to a degree, it's all relative, right? So you just got to figure out what lane you're going to stay in, what your strategy is. Are you a fee-based asset manager, not banking on, but you're in more of a long-term debt reduction, principal build-up play? Is that your business model? Or are you a value add where you have to get out on the back end? You need to understand that reversion cap rate needs to be higher than your going in cap rate. So you got to take that into account. Is there room there? So you just got to figure out your business model, figure out your biggest business plan, stay disciplined and stick with it, and watch those interest rates.
Okay, I was trying to take so many notes right there, Greg. That was good. That was good stuff. I hope the listener is paying attention.
You got it recorded, so.
That's right. You can go back, hit the back button. So that's awesome. You mentioned, we'll go through a couple points there that you had highlighted, but talking about being an equities market, there's fixing to be a boom there, or a bomb in there. You're talking about, can you elaborate on that a little bit? Like a listener that says, oh, wait a minute, what's he talking about? Equities market. What does that mean?
That's stocks. So equities are stocks. So right now, all of the indexes are at all-time highs, right? The Dow Jones, the S&P, the NASDAQ, everything, all around the world. They're just maxed out right now. And it's because of the monetary easing that we've seen in the Fed's balance sheet and the government's pumping, money into our economy, buying our debt. So, that has artificially inflated the price of that asset equity. So a lot of the sovereign wealth funds, institutional funds, foreign wealth funds are going into the equities market, and they're moving big dollars. So it's a big game. A lot of the hedge funds are in there, and the values of these companies just do not make sense. Everybody will tell you you listen to CNBC and you watch all the smartest people in the world that do this every day. And I'm not a stock guy. I just know market fundamentals, right? And when everybody's in, that's when you need to be going the other way. And if you watch Warren Buffett, who is our greatest investor of all time, who's never changed his strategy his entire career, he's going to cash and he's waiting. So he's going to, just like he did in 2009, he's going to jump in when things start going south. And he tells a story of getting a phone call. Like, people say, why are you cash? He said, hey, I got a call the other day. Somebody needed $50 billion by Monday. I was the only guy they could call. He said, so when you have cash, you get phone calls like that. So watch Warren Buffett, watch interest rates. And I think, the markets are maxed out. Can they go any further from here? I don't know. I really don't know. I do know they can always come back. And, I'm not a, bear market guy. I'm not a doomsday sayer. I'm just saying, be careful and watch out, because it feels like we've maxed out. It feels like we've hit the ceiling. The markets have tried to push and reach that breaking point. And they haven't been able to push past it and keep going on the upside. Every time we break that ceiling, it pulls back. So that's kind of telling you that there's a limit right there. And, good times never last, bad times never last. And, bull markets, always pull back. They always pair off. And we've got a lot going on, with this whole, epidemic that we're facing with the coronavirus. That's really affecting the economy. A lot of people are predicting a mild recession because of it, depending on how bad it gets. I don't know if it's that serious, but it's pretty serious. But at the end of the day, a company is worth the income that it can produce. And we're seeing a lot of pressure right now in earnings reports on a lot of companies that aren't as healthy as they have reported and that we have thought they were. So just keep an eye on those things and be careful if you're in the stock market.
So you also mentioned like interest only debt right now is how a lot of investors are able to do deals right now, right? And make it happen. Is that something we should be scared of?
Yes. That's what caught a lot of people off guard in pre-2009 was the interest only LIBOR loans that we were all getting for commercial and residential real estate. That
LIBOR is like same
debt.
as bridge, right?
Yeah. LIBOR is London index bank rate. So it's always a little bit lower than the Fed rate. So they were basing loan rates on that. But yeah, that was in short-term bridge type debt. Typically it's interest only, so you're not paying down any principal. Your payments are cheaper, so your cash flow is inflated, or you have a bigger yield on your cash flow because you're not paying principal. But again, you're not paying down any principal. There's not a lot of cash flow left at the end of the day. I mean, if you're buying a 5 cap and you're getting 3 3/4 interest, by the time you put your reserves away, pay all the bills, there's no money left over. You're going to break even, and you're not reducing the principal. So that's a dangerous place to be in because you're banking on appreciation. You're banking on being able to add value, raise rents, things like that. The other thing I'll caution people is make sure you understand that you're not always going to be able to raise rents exponentially. A lot of people were saying, hey, rents double every 10 years. That's just not the case. Rents have not doubled in the last 10 years, and they may have prior to that, but we've seen them increase. But we're kind of reaching a threshold now where, people can only go so far. There's only so much they can spend because incomes have not grown exponentially in relation to rents. And somebody put out a chart the other day that showed where rents are right here and incomes are right here. They've been flat as rental rates have shot through the roof. So you're going to reach a point of pushback and a point of diminishing returns where you can no longer increase rents. So if your whole business plan is based on, I know I can increase rents exponentially, you might be able to get a year or two. You might be able to, depending on the asset, if you're a $1,500 a month apartment, you might be able to squeeze another 100 out of it. But if you're an $800 a month apartment, renter, that $100 means a whole lot more to you than the $1,500 guy. So you got to understand what your assets are, who your renters are, what those increases mean to them, and what are their choices. If I'm renting an apartment for $800 to $1,000 a month and you want to raise my rent $100, and I can go, a block away and get 2 or 3 months free rent, I can get a U-Haul for $100 to move myself. So, that's what you got to watch out for. Just be careful. I'm not like negative or anything like that. I'm just saying these are the things you need to think about when you're looking at these aggressive deals right now.
So you mentioned earlier also about this reversion cap rate. And of course, we talk about that term and that a lot in the business, and especially analyzing deals, or investors always ask about the cap rate, or going in cap, the exit cap. Could you elaborate a little bit? What is the reversion cap rate? If a listener is saying, well, what in the world is he talking about? But what is that?
So reversion, like you said, that's your exit cap rate. So when you buy a property at a 5 cap, to assume that you're going to be able to sell it for lower than that down the road when you exit that property at reversion, when you fulfilled your business plan, is unrealistic. Generally, you need to figure you're going to be a point or two higher cap rate than you bought it at. That cap rates are going to increase, not lower or stay the same. Now, granted, if you look back 5 years, they've gone down. But, the prudent investor has to assume cap rates are going to go up, interest rates are going to increase, and the property is going to be trading because it's older, and it may be less desirable depending on where the market stands and new supply in the market, things like that. So you always need to be responsible in your underwriting and assume conservatively that the property is not going to trade at as low a cap rate today as you're going to sell it for 5 years from now.
So when you say a point or two higher, what does that mean?
So, if you're buying a 5 cap right now, you need to assume you're going to sell at a 7 cap. Now, you've increased the income, and hopefully you've become more efficient in your operation, so that, at the end of the day, it's not always rent increases. You want to increase the income. So that can be done through operational efficiencies. It can be done through other residual income centers throughout the property, laundromat, cell towers, billboards, other things that you can leverage to generate income off of that property, not always just rent. So you want to enhance the income. So that ultimately drives the value. So even if you have a 1% or 2% higher cap rate at the back end at reversion, when you exit the property, you still have good upside and profit in the deal because you've increased the overall value.
Yeah, and you mentioned too a minute ago, like your property is going to be older when you sell it. I feel like if you're already buying a property that was built in the 50s, I mean 5 years from now, I mean it's still built in the 50s. It's still it's going to be 5 years older, and it's not accounted for sometimes.
Well, I had somebody today I was talking to, and they said, so Class B, they're saying, so anything built 90, 95. I'm like, no, this is 2020. If you need something in the 2000s. To stay in Class B, and actually mid 2000s. I mean, that's 15 years old at this point, right?
Right.
So it's, a lot of those ABC rules haven't been updated, because it's years back, but a lot of people aren't connecting those dots. And like you said, thinking about something that was built in the 50s, I mean, time goes by quick. So it's 2020. So you need to be looking for value add, in the 2000s now.
I think sometimes it's just hard to feel like it's 2020. I still feel like it's like year 2000.
Yeah. Yeah.
So Greg, what, anything else as far as the way, people, clients of yours or other people in the industry that, that are looking at the market that kind of scares you?
The prices that some people are paying are aggressive. So what's happening out there that you need to understand, if you're looking at a lot of these deals and they're not making sense and you're seeing them get closed and get done, understand that there's a lot of 1031 buyers out there that are, selling assets that they were in 5 and 10 years ago. So they're, they're doing a 1031, they're going to pay a little bit more. They're going to be a little bit more aggressive. So that's some of the buyers. Some of the other buyers are buying more on a yield and a principal play, pay down play, like I said. So they're looking at, hey, I don't mind paying a little bit more now. It's a good asset. I've got a nice little yield. Maybe I'm going to make 3% cash on cash or 10% or 5% cash on cash. And I'm paying principal down. So in 20 years, I'm going to own this property free and clear. Some people have that kind of a long-term outlook on these aggressively priced, well-located class, A core plus assets. So that's what's going on there. So I wouldn't get caught up in, trying to figure out, man, why are these deals getting done? How are they doing those deals? Just stay in your lane, figure out what works for you and your investors. Don't get distracted by what everybody else is doing. Don't get pulled into thinking you got to do a deal just to be doing a deal. Have your plan. And, it's an aggressive market right now. So there's nothing wrong with having a fee-based principal pay down business plan where you earn an acquisition fee, you earn an asset management fee, which just covers your overhead. Then you've got an exit fee when you refinance and or sell that asset. And along the way, you're reducing principal, which is going to build equity in the property versus adding value and increasing the value so much. Hopefully you can increase the efficiencies a little bit through a portfolio play. If you've got a number of assets, you can find economies of scale to reduce operational expenses. Then you've got a package of product that the bigger funds are now interested in, right? So it's kind of like the Warren Buffett problem. He's got so much money, he has a hard time finding big enough deals to do. Same thing with institutional investors. They're not dumb, but they do have a lot of money. So they can't move 10, 20, $50 million. They need to move 3, 500, $1 billion. So if you're collecting the right kind of assets, core and core plus, you're earning fees along the way to pay the bills, and you're paying down some principal. If you put together a nice $300, $400, $500 million package to $1 billion package, that's very attractive to some of these funds that are looking for yield. So that can be your exit.
I like that. Yes. So you mentioned core and core plus. What is that?
So core is stabilized class A, B plus type assets, in primary, secondary markets. Core plus has a little bit of upside. It's above value add. It's a newer product. It's going to be, A minus, B, D minus in that range. Again, primary, secondary markets, sometimes tertiary markets if you have a major university or something like that that's driving those plays. So the difference really is, what you have is you have distressed, then, opportunistic distress, then you have value add, and you have core plus, step up, and then you have core, which is done. And it's usually newer, nicer, new construction. A lot of people will equate core with class A. It doesn't always have to be class A. It just needs to be stabilized, nice, where there's really no value add. That's already been done.
And, you and I briefly talked about this before we started recording it, but like you see more developing happening now just because of the difficulty of finding deals. Is that right?
That and supply. So, there's not a lot of properties out there, and there's a lot of demand for units in a lot of markets still. I mean, when you look at a national average, believe it or not, we're still undersupplied in housing units. So that can make development attractive. A lot of people are going with that model. That's a long-term play. You just need to be prepared for a 5-year haul and zero income for the first 2 to 3 years. Because it's going to take you, a couple of years to get it approved, get it mostly built to built, leased up, depending on the size of it. Smaller properties, you can lease up quicker than bigger properties, to stabilized. So that's going to be a 3 to 5 year play, kind of like a value add, but those are a lot of fun too. So a lot more people are getting into development, especially smaller mixed use deals. So you can do, a nice 20, 30 unit, $3 to $5 million building here or there that fit in very nicely in different areas and different demographics. those are great little assets that are easy to lease up. They're quicker. You can get them done in a couple of years, and there's a good market for them at the back end.
What's your thoughts on the types of debt that are? I know we talked about a little bit about debt, but like specifically, let's say bridge debt right now. Like your thoughts about the types of deals that people are using bridge debt for, or should we be running from bridge debt?
No, I think it's fine. So again, on the new construction, that's the other thing. So HUD has a program, 40 years, non-recourse, 95%. Freddie and Fannie have good construction loan products as well that they'll give you, I think, some high loan to cost on those deals with long-term non-recourse. So there's some really good construction debt out there. Bridge debt is often used for the construction portion, and then it gets converted to that permanent on the back end. But I think what a lot of people are doing is doing bridge debt with maybe a supplemental loan on the back end to do the value add portion reimbursement, so they don't have to do a complete refinance at the back end. So those can be really nice, attractive products. There's also floating rate loans where you can adjust that rate every so often without penalties or without a full refinance. So I think those are fine. I don't see the difference between now and 2009. I don't see any catalyst where interest rates are going to increase. Okay. The Fed is talking about holding rates. They want to see some inflation, which you can't raise interest rates to create inflation. The rates have to stay low to create inflation. They want to see 2% inflation. The only way to do that is to hold rates or lower them. The Fed is talking about holding rates and potentially lowering if they have to. So what's really cool for where the space we're in real estate is if the market does have an issue, or if things do start to go south, the Fed's going to cut rates. So that's even better for real estate investors. So that's what you really want to watch, those rates, because we could be looking at 2 3/4 a year from now, 6 months from now. I just don't see any catalyst for interest rates to raise exponentially anytime in the near future. The Fed doesn't either. They just don't have that in the horizon. We can see inflation, but they're going to hold that in check with keeping the rates low.
Well, unfortunately, we're almost out of time, but just a few more quick questions for you, Greg. But what's a way that you've recently improved your business that we could apply to ours?
For me, just constantly pouring into myself, developing myself, educating myself. So I improve everything I do through educating myself. I read constantly. I listen to things constantly. I study the markets. I watch CNBC. I listen to what's going on outside of my industry. So you got to be in tune with what's going on around you to really be effective in your industry. As far as my business model goes, I'm pretty consistent. I do the same things. I'm my superpower, we talked about that. I'm a delegator. I'm a leader, motivator, delegator. So, I turn things over to other people so that I have the time to be at the high level and be the visionary, be the creator of the enterprise that I'm in charge of, that I've been blessed with. So, for me, it's just that constant enhancement of my own mental capacity and vision.
Are there any other ways that you're educating yourself or staying on top of the market?
Yeah, just reading, watching, learning, talking to other people.
I know you mentioned like watching CNBC. I didn't know if there was anything else.
Yeah, CNBC is, for the financial markets, there's obviously Bloomberg, the national news. So I watch both sides of the news. I kind of keep up with what's going on politically and things like that as well. So I do watch the news regularly. I'm not like obsessed about it, but I watch the evening news, and I watch a little bit of Fox, and I watch a little bit of CNBC, a little bit of Bloomberg. And then I talk to people in the business. So I have friends that are on Wall Street that are with the big investment banks, with Goldman, with BlackRock, with, Solomon Brothers, and people that have been in those firms that are in that world. So I talk to them all the time, much smarter than me, much more sophisticated, that have been in the thick of it. One guy I'm having lunch with next week worked at Lehman Brothers when they were going down, and now he's buying mobile home parks and storage facilities. So, so I just try to talk to as many people as I can, people like you, people that are in industry out there doing things, and just try to listen and learn. And believe it or not, I know I talk a lot here, but that's the purpose. When I'm talking to an individual, I'm asking questions, asking good questions, seeking knowledge and wisdom, and listening.
And that's what I get to do every day.
Yeah, that's a lot of fun, isn't it?
It is. So Greg, what's the number one thing that's contributed to your success other than asking good questions?
Being a seeker of wisdom, seeking to help other people, trying to be of service to other people. I've learned everything that you do in life is all about serving others. So when you seek to understand the other person first, seek to serve them first, then everything else takes care of itself.
And how do you like to give back?
Helping
what you
people.
Just mentioned.
Yeah, helping people. So, I've got an education company. I'm really focused on that right now. I've created the MBA level education for the everyday entrepreneur. So I'm really focused on giving back and helping as many people as I can by sharing my 23 years of mistakes as well as success. I'm involved in a lot of ministry efforts in and around the country and the world. I support a lot of different charities, both Christian organizations as well as in nonprofits and community organizations and associations. So I'm just a giver, man. That's another superpower. I was born with that. My parents were always like, "You're the guy that would give anybody the shirt off your back," and I'm like, well, just how I was born.
That's awesome. Well, thank you for sharing that, Greg. I know you've shared lots of wisdom with myself and the listeners today. It's an honor to have you back on the show and get to know you even a little better. But tell them how they can get in touch with you.
Yep. So gregdickerson.com is my website. Everything's on there. All my social media, YouTube channel. I've got a YouTube channel that I put out videos every day. Short, quick, just meaty, how to do this, how to do that, what we just talked about in little 2-minute bite-sized pieces. So I do that every day, and I'm on all of the social media platforms. So you can find it all there, gregdickerson.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.